Alan, great to have you here in studio. Thanks for coming on down. A busy Friday morning, a job report.
It's Friday fun. This is like the good old days.
You've got 100 places you could be right now.
We're ready. We're ready for the fun. This used to be a good time back on the floor, getting ready for the Friday number.
I'm reminded of your pit side hits with Phil Flynn standing there and some of the back and forth you guys used to have. Let's try and get that going here today.
All right.
Okay. First and foremost, the jobs report. Your thoughts. What should we be looking for, and implications on the Fed?
The market's momentum. We've got the stock market up. We've got yields coming down and the dollar drifting lower. So I don't look for anything to change at any time here. So, we'll see how the markets react. But we've had a perfect scenario as far as the Fed goes. No one's going to like what I'm saying. But they have played this absolutely perfectly, and the results are what I focus on, strictly results.
Fed Chair Jerome Powell, the master of walking that fine line, balancing things out. I was just talking about
tough love. He does tough love to people.
And the market has received it very well in many ways. Okay, Alan's here to talk about a very interesting topic today, and we're going to kind of shift gears and take a heartbeat before we get into that jobs report a little bit more at the bottom of the hour. Again, non-farm payrolls. But Alan, you're here to talk about some of the myths associated with trading futures, commodity products specifically. Let's get into first and foremost. I like this one right at the top of your list. Commodities are more risky than stocks. You say, hogwash, you throw it out the window.
Well, that's why I'm here, because I'm trying to bridge the gap with people. Trading is about taking advantage of opportunity. And now is the best time in history to be a trader/investor. Nobody really invests anymore, buys a stock and throws it in a drawer and forgets about it. People have a plan. And now with the electronic markets that have changed our lives, obviously, you can execute a trading plan anytime, any market, any direction. So the opportunities are endless. But I think a lot of people kind of neglect the futures markets. They pay attention. That kind of sets the tone for them. But there are huge opportunities here, and I want people to be comfortable enough to go after that, because it all comes back to commodities. Every investment decision, commodities are the foundation, the building block for the financial markets. And I think what's happened here with the financial futures, and now we're talking about these E-minis. E-minis are one of the biggest products in the last 50 years. That's changed everything for everybody, and I think it's an opportunity that people have to take advantage of. It's simply the same as any other trade. You want to control your risk. You want to be able to have liquidity, and that's what these markets provide.
I would agree with that. Commodities at the epicenter of many of the moves that we look at here on the Future Show, and many of the moves that our viewers watch in terms of individual stocks and some of the sectors they watch as well. Also, I would argue in terms of this that, hey, again, not riskier than stocks necessarily either, right? But also some of the approaches that one has towards trading stocks, you would have very similar approaches towards trading futures.
Trading is trading. It doesn't matter what you trade. It's how you trade that's important, okay? No one should be have extra concern about the underlying product. It's about having discipline, and it's about having a trading plan, define risk, and it's about probability. That's all about.
So strategies are strategies. Again, they will apply.
They all apply here. ETFs, and for us, we learned all of our strategies in the futures markets, in the commodities markets, and now we apply them, or I apply them personally, to the stock options market.
Insiders have an advantage. You say no way.
It used to be. That's why we were down there. That's why we were down there.
You had edge.
You had edge. And we were providing liquidity. And you had edge, and you were providing, a service to the marketplace. But that's not necessary anymore, because everybody has equal access now. Anyone can press a button from anywhere in the world. You could trade anywhere, anytime, any direction, any market. And so that opportunity is there. And, it used to be a boys' club. That's why I used to pay $10,000 a month.
And that's why the minis are here. We were talking about that earlier, right?
The minis evolved because of the...
People were getting sick and tired of...
Inefficiency, that's the word. The inefficiency of execution back in the day. And plus, you had to wait. It's very efficient. You got to understand, for 150 years... People called in an order. An order went to a runner took it in the pit. The guy endorsed it.
And then he had to wait 45 minutes.
And he brought it back. And, that's how trading worked.
Half the time you were stopped out before you even got your fill in. I remember. So hey, you've got another couple, which I like here. I want to move on. We got to hop. Commodities cost a lot of money to trade, and you also talk about how commodities are only for short-term price moves. You say false.
Absolutely wrong. You can use the markets in many ways. I use them to position for the longer term. And a good example here is that you just mentioned the E-mini. E-mini is $50 a point. Okay, $50 a point times 5,300. It looks like 265 $1,000 is the value of an E-mini contract. Now, you're putting down $12,000 if you're trading the futures to trade that contract. Now, if you just took advantage of the last 300 points from 5,000 to 5,300, there's some great money to be made.
Yeah.
And that's occurred over a period of months. So you could have just sat on an E-mini contract. I know people trade, actively with it, but you could have just sat and used that as your vehicle instead of sitting in the SPY or instead of sitting in a stock.
Alan, these are all topics that I want to dive deeper into, especially this one. This is leverage, which is what you're scratching the surface on here, and I like that. But you've got another one, which this is one of my favorites, so I'm glad we saved it for last, because I actually do remember a story as being a runner on the trading floor. The guy that got me into the business talked about how one Christmas, his boss gave all of his clerks eggs for Christmas because he had received delivery on a contract of eggs, basically. But you say, hey, a truckload of corn is not going to show up in your backyard.
No.
Okay.
First of all, because when you're trading the futures or commodities markets, you're putting down 10% deposit typically. That's what your deposit your margin is. Now, that's a small percentage of the actual value of the contract.
The notional value, which you just mentioned in terms of the S&Ps.
Right. If you wanted that 5,000 bushels of corn, guess what? You're going to have to buck up.
Yeah.
You're going to have to
cost you a lot more.
It's going to cost you corn prices, at $3 or whatever. Multiply that by 5,000 bushels. That's how much you're going to have to pay for all that corn to get it. And actually, you get a delivery slip. It sits in a silo.
Yeah.
Then you have to go get it. So it's a whole complicated procedure. Futures
never happens.
Never happens.
Right.
Futures, you just want to be out of them by the first notice day or the last trading day and just roll into the next contract and find another opportunity because they're endless, absolutely endless in these markets.
Yeah, I would have to agree. And I should correct myself. I shouldn't say it never happens because that's the whole point of futures, right? Is for that delivery to happen. But for you and I as retail traders to receive that delivery,
your brokerage is going to prevent that.
They're going to get you out of the position first.
They're going to help you along the way.
Prior to rollover. But again, these are all topics of inquiries, topics of conversation to have.
Right. I want people to be more comfortable with the markets. Yeah. And there is, an image of the futures markets from maybe 50 years ago or how it used to be.
It's changed.
We are old grizzled traders, Ben. We saw the evolution. I saw it come from the first financial futures contract were the treasury bonds, and that revolutionized everything. Because before that, it used to be physical commodities you could hold in your hands. And now you've got currencies, you've got Bitcoin futures, which is it a futures contract?
Yeah.
Or is it a commodity?
Yeah.
What is it? So there are a lot of opportunities, but I think people have a kind of a stigma that they need to overcome because there are amazing moves financially in these markets to take advantage of.
A long way from the old days of the CME floor where they're calling out butter prices, right? Pork bellies, live cattle. But I've always argued you can take the trader out of the pit, but you can't take the pit out of the trader.
That is definitely true.
All right, Alan Knuckman joining us in studio on a Friday, a very busy Friday morning ahead of the jobs report. Appreciate that. And thanks to Alan. You can check him out, Chief Market Strategist at bullseyeoption.com.